Happy spring. Beautiful sunny day in upstate New York, and I want to welcome you to this edition of the Custom Wealth Management Quarterly Commentary. I'm John Enright, and I'm here to recap the first quarter of 2019. We all welcome the new year as an opportunity to say goodbye to the worst December in the U.S. stock market on record. Many expected the markets to continue their decline, as it seemed to spare none in the equity markets, whether it be domestic or foreign. The markets worked to price in the expected reduction in corporate earnings, softer global growth, political uncertainty, and tighter monetary policy. The markets remain difficult to predict. It's analogous to predicting human behavior, which is perhaps the greatest influencer of the market performance. The resilient investor prevailed in January and in February, bringing a substantial turnaround in the markets, both domestic and foreign. And March results were much more subtle, with less than a 1% gain in most of the major indexes. The fourth quarter downturn did bring valuations to a level where many investors regained confidence. However, when looking at money flows, most investors did not share in the recent market increases, considering equity flows. In a piece titled, "Top Money Managers Warn of the 2019 Risks" from wealthmanagement.com, 11 very well-respected individuals were interviewed, and it was a near consensus in terms of the attractiveness of emerging markets, while the opinions on fixed income and U.S. equities ranged from very pessimistic to somewhat optimistic in their outlook. Little agreement amongst the top money managers in the industry is nothing new, and it certainly reassures us of the need to stay diversified, yet not diluted, and diligent in our efforts to identify quality managers to assist in meeting your financial goals. We were quite active in our trading to fixed income in February, and we continue to look for opportunities to deploy cash with a primary focus on opportunities in the international and in the emerging markets sectors. Given continued expectations for volatility, we also find very good reason to maintain the defensive allocations in funds, which tend to experience lower volatility. With the recession radar constantly alert in the United States, and negative interest rates in the euro, resilient investors may continue to prevail regardless of these headwinds. REITs, real estate investment trusts, were the strongest performing asset class in the first quarter, with a whopping 17.2% climb. Cash, while much stronger than even 2017, returned at 0.6% for the quarter. And in recent weeks, mortgage rates ended their recent climb and have settled back just in time for what could prove to be a very strong spring market for home sales. I'm hoping so, as we have our home up for sale. With a 10-year Treasury below 2.5% and the Fed giving every indication of no action for the year, we may be enjoying reduced mortgage rates for longer than even expected. We may have experienced the majority of 2019 gains in the first 2 months of the year, especially considering the pace of returns realized in January and February. As always, our efforts will consistently be to manage through the business cycle and manage risk while still seeking strong results. While downturns and upturns might come in very short spurts, our philosophy remains to manage towards your longer-term financial objectives. Please feel free to reach us with any questions you may have, and we look forward to connecting with you soon. As a disclaimer, I have to provide you with this notation that these are the opinions of myself, John Enright, and not necessarily those of Cambridge. They are for informational purposes only and should not be construed or acted upon as individualized investment advice, and past performance is no guarantee of future results. Thank you very much, and we look forward to speaking with you soon.